Morning, everyone. Let me just start by thanking the City UK for the opportunity to speak at this 10th anniversary event at what is such a critical time, of course, for the financial services sector and for the economy as a whole. I'd also like to thank them for giving me the opportunity to put a tie on today and to smart myself up, if only temporarily in my case. We're all living in hope of the 3 R's that are the theme of this year's conference. That's to say recovery, rebalancing and revitalization. And with recent news about vaccines, perhaps some of that hope, cautiously expressed, is now justified. Today I want to focus my comments on the middle of the 3 R's, rebalancing, why it's needed and how it might be achieved. But let me start with a word about the macroeconomic backdrop. It's plainly been a roller coaster year for the economy. Economic activity fell by around a quarter in the first half of the year, a fall whose scale and pace has no recent historical precedent. During the third quarter, and surpassing expectations, the economy recovered around 2/3 of those losses. And that's testament really to the resilience of households, businesses, and the financial sector, who've worked with government and the bank and other regulators to support activity, incomes, and jobs. With a second lockdown now in place, as we all know, economic prospects for the final quarter of this year remain very uncertain, and economic activity seems very likely to remain well below its levels at the start of the year. Nonetheless, looking into next year, provided public health restrictions are loosened and with a vaccine hopefully on the horizon, economic prospects look brighter, perhaps materially brighter, than might have been expected as recently as a few weeks ago. Whatever the path of the economy from here, it's clear that the COVID crisis risks, however, leaving some lasting scars. It's already resulted in over 50,000 deaths across the UK, more than 1 million people losing their jobs, perhaps 9 million people seeing their incomes cut, and the whole country left feeling much more anxious about the future. The role of public policy this year, including monetary and fiscal policy, has been about trying to cushion the effects of the crisis on households, on companies, and on banks, thereby limiting the depth and the longevity of these scars, whether economic or medical or indeed psychological. And that's why monetary and fiscal policies have reacted on an unprecedented scale and indeed at an unprecedented pace during the COVID crisis to protect jobs and incomes, spending and lending. And it will continue to do so as long as those risks remain elevated. COVID's also likely, however, to reshape some of the imbalances in the UK economy, many of which were both deep and long-standing even before the crisis struck. One of the most important of these imbalances pre-COVID was the generational imbalance between young and old. Even before the crisis struck, the lifetime real income profile of people born in the 1980s was no better than that of people born in the 1970s. In other words, for the first time in perhaps a century, today's young people are finding themselves no better off financially than their parents. That in part reflects the effects of the global financial crisis, which put back the income and job prospects of younger generations, as recessions almost always do. Pre-COVID, the picture on home ownership among young people was in some respects worse still. Today's 30-somethings are far less likely to own a home, not only than their parents, but than their grandparents at the same age. If that was the situation pre-COVID, it seems very likely this year's events will worsen further these generational imbalances. Like past recessions, this crisis is hitting hardest the young and those with fewest skills and experience. Youth unemployment started this crisis roughly double the national average. During the course of this year, the rise in the LFS measure of unemployment among 16 to 24-year-olds has been more than 3 times larger than for other age groups. The costs of not getting your foot on the first rung of that jobs ladder are known to be large and to be lasting. And the COVID crisis, I think, runs the risk of removing that first rung for many young people. And the same is likely to be true of home ownership. So the hit to jobs and to incomes from COVID will make it harder for young people to save for a deposit. And meantime, in the mortgage market, the high LTV mortgages usually taken out by young first-time buyers have all but disappeared over recent months. And taken together, that means it's also likely to be harder for young people to get their foot on the first rung of the housing ladder. Again, further worsening generational home ownership inequalities. Suffice to say, I think addressing these wide and widening generational imbalances will be one of the key policy priorities as we emerge from this crisis. A second set of imbalances which stood out pre-COVID were regional imbalances across the UK. Let me give you a few facts on those by way of context. Pre-COVID, the gap between the levels of income or wealth or productivity between the UK's richest and poorest regions ranged between 40 and 60%. In other words, the largest of any country in Europe, bar Poland and Romania. What's more, having widened over the past several decades, these regional imbalances are now higher, larger than at any point in at least the past century. You have to go right back to late Victorian times to find spatial imbalances as large as they are in the UK today. And what's true of income and wealth is equally true of regional disparities in, for example, levels of educational attainment, or levels of poverty, or levels of life expectancy. In fact, if you take it at your microscope, you find that these imbalances across regions are, if anything, larger still within regions. The closer you place your magnifying glass to the map of the UK, the larger these spatial inequalities often appear to be. Now, interestingly enough, the one metric that bucks these trends is well-being or happiness. I mean, the most miserable place in the UK, by some margin, is the place I sit today, by which I don't mean my office, although who knows, by that I mean London. But London's also, by some margin, the richest place across the UK. By contrast, the happiest place in the UK, Northern Ireland, is also one of the poorest. I'll come back to why that is and how it might have changed in a second. Anyway, this was the map, the regional map at the start of the year. The question is, how has COVID reshaped this regional map? Well, the picture, I think, is actually a rather nuanced one. There are parts of the UK, in particular some of the coastal towns and rural regions, heavily dependent on hospitality, tourism, and culture, where COVID has frankly made a bad situation even worse. It's left an even more of a performance gap needing to be leveled up. Interestingly though, this pattern is not uniform. For example, some of the best performing parts pre-COVID across the UK, notably some of the larger cities, have been among the hardest hit by COVID. Cities are well known to benefit from so-called agglomeration benefits, as they serve as a magnet for jobs and skills and culture and finance and commerce. Those agglomeration effects have been particularly powerful over recent years, which is why we've seen the rapid emergence of so-called global supercities. Pre-COVID, population density exhibited a strongly positive correlation with the growth and level of economic activity across the UK and elsewhere, with London at the top of the UK table. COVID has turned this pattern on its head. The largest contractions in economic activity this year now show a strongly positive correlation with urban density, with London again leading the way. At least among cities, COVID has been a great leveler. Unfortunately, this has been leveling down, not leveling up. Now, the one exception to this rule, again, is well-being. Commuting is well known empirically, and I should also say from personal experience, to be a killer of happiness. So the sharp fall in commuting in and around larger cities is likely to have leveled up well-being in London and elsewhere, at least to some degree. Now, looking ahead, my guess would be that COVID will slow, but not reverse, those forces of agglomeration I mentioned. The benefits of cities, infrastructural, cultural, civic, will remain, and the centripetal forces of skills and business and finance, I think, will resume in the fullness of time. But I also think that with remote ways of working and digital ways of doing business, those practices will persist long after COVID has abated, and those centripetal forces will most likely be somewhat weaker than in the past, with a resulting somewhat more even spread of economic activity across the UK. In fact, I go further than that and say that the behavioural shift towards more decentralised models of working, spending and doing business offers real opportunities for satellite towns and cities and rural regions across the UK who pre-COVID often found themselves left behind. Now, if I'm right about that, that begs the obvious question, what needs to be done to seize this levelling up opportunity and correct on a durable basis the UK's yawning spatial imbalances? And within that, what role might be played by the financial and professional services sectors? Well, turning the tide of growing regional imbalances will require concerted action across a number of fronts. So in closing, let me confine myself to just 3 points. First, to sound another note of cautious optimism, experience in other countries demonstrates very clearly that concerted action can make real inroads in regional imbalances. That international experience demonstrates that levelling up is eminently doable, provided a regional strategy is put in place that operates at scale, has longevity, and that has focus. 3 ingredients which regrettably have been sadly lacking from past regional strategies in the UK. Second point, and again, based on international experience, any successful regional strategy needs to be designed and crucially implemented at a local, not national level. As all politics is local, so too is all economics. Indeed, in the UK, often very local. And that makes next year's white paper on devolution across the UK even more important when it comes to making a success of levelling up. At present, the civic infrastructure, resources, personnel, institutions, simply does not exist across some parts of the UK. Across the UK, having that in place, I think, is a necessary condition of successful levelling up. Third, and finally, one of the key sources of regional disparity is, of course, the uneven spatial distribution of resources, education and skills, innovation and investment, and infrastructure, both physical and digital. Action is needed individually on each of these imbalances. But there is another imbalance just as important, and that's the imbalance in the availability of finance to different regions of the UK, especially company finance. In some respects, this patchiness in company finance and in SME finance in particular is an old and long-standing problem. It can be dated right back to at least the Macmillan Committee in the 1930s, the so-called Macmillan gaps in SME financing. For two reasons, though, I think now is a singularly opportune moment to be filling those gaps decisively once and for all. First, and most obviously, the need for finance among UK companies has rarely been so pressing. By that I mean not only the need for financial capital to catalyse growth in the less well-performing parts of the country and to close those regional imbalances, a need that's existed for many decades. I also mean, though, the increased financing needs that have arisen as a result of the COVID crisis, with around 1.5 million companies having taken on new debts to tide them over the crisis. These debts will need to be either repaid or refinanced or restructured if the debt burden is to be lifted from company shoulders and growth is to return at pace. Second, recent developments in data and technology mean, I think, more than any time in the past, the closing of these financing gaps is feasible provided the right infrastructures and institutions are put in place. The proposals made by the City UK earlier this year and led by Adrian Montague would be one example of such an institutional solution. And in a similar spirit, a number of proposals have been made for putting in place a national investment bank, co-funded by the public and private sectors, operating on a regionally decentralized basis and servicing the needs of businesses, in particular businesses in some of the more financially excluded parts of the UK. These institutional proposals, I think, merit serious consideration when it comes to delivering the 3 Rs. Another very much complementary proposal was outlined by the Bank of England earlier this year, namely the creation of a new financing infrastructure for SMEs, a so-called open data platform. This would build on the foundations already laid by open banking. The idea is to create a standardized means of permission sharing of data on businesses, not just data held by banks as under open banking, but importantly, in addition, data from all sources, both private, for example, insurance and utility companies, and public sources such as HMRC and the DVLA. At a practical level, what would this mean? It would mean that an SME could, at the touch of a button, permission an API call to a handful of data providers to instantly and securely share specified data with a third party, such as a prospective lender. That would greatly expand the data set and shorten the onboarding process for SME loans. For example, digital identification and verification through the platform would reduce KYC and AML checks, and customers, borrowers, could cheaply and quickly compile and share their bespoke credit files with different lenders. For lenders themselves, a less costly onboarding process and credit risk assessment process would lower, potentially materially, many of the long-standing impediments to SME financing. Indeed, the platform would potentially lower barriers to entry by new innovative lenders, thereby improving the contestability of the SME lending market and making it easier for businesses to shop around for loans. In some respects, such a platform, such an infrastructure, could not be better timed than now. It could help not only in the resolution and refinancing of existing debts by companies, as large as they are, but also in the provision of seed core financing to new firms as they hire and aid recovery. And by opening up new data and new suppliers, it would also prospectively offer the greatest benefits to high growth companies operating in the least well-served parts of the country, thereby alleviating some of the financial constraints on levelling up. Let me conclude because my time is more than up. The COVID crisis has led, as we all know, to a dreadful loss of lives and livelihoods and does run some risk of leaving lasting scars. But new digital opportunities are also opening up that could help to heal some of these scars in ways which support both inclusive growth and levelling up. As it enters its second decade, the City UK, working with the bank, with the financial services sector, with others, has, I think, a pivotal role to play in seizing those opportunities. They too could add to the growing mood of optimism over recent weeks as we approach what we all hope will be a genuinely new year. Thank you all for listening.